Good morning, ladies and gentlemen, and thank you very much to Kerry. Let's start. Can you guys hear me? Am I laudable? Okay, I see people saying yes. Okay, let's go. Today we're doing group financial statements. It's a new chapter, a new book. It's not on group financial statements, 18th edition by Prince Lou and Fawcett. EFFSC 3, IS 27. I think we should have added EFFSC 10 as well, because there are some concepts that we borrow from EFFSC 10. Just some terminology to look at. We've got what is known as a parent and then a subsidiary. A parent, it's a company that owns or has majority shareholding in another company. So that's the holding company, basically. And then it will have investments or subsidiaries, and the other one would be associates. So a subsidiary, it's the company that is owned by another company. If you can have a quick look at practically, it's companies that I believe we all know. If I may ask, who owns game stores? We all know game, I like to believe. Who owns game stores? Game, where we buy most of the stuff. Who owns game, ladies and gentlemen? Someone saying Walmart. Okay, I'll come to that just now. Any other attempt? Someone saying Massmart, someone saying Macro. Massmart. Okay. Game is owned by Massmart. Massmart owns Macro. Yes, Massmart Holdings. It owns Macro. It owns Game. It owns Builders Warehouse, and other companies. Now, so Massmart is, in fact, interesting. Someone said Walmart. Massmart is owned by Walmart, which is a US company, but we're not going to get into that. We're just going to end at Massmart level. So Massmart owns Game, Macro, Builders Warehouse, etc. So in this instance, the parent is Massmart Holding, Massmart Stores Holdings, they're on top. Then we've got different subsidiaries, as we say, Game, Macro, Builders Warehouse, etc., etc. Okay. Now, a company by law is a separate legal entity, and the Companies Act requires that the company must prepare its annual financial statement in accordance with EFFSC. Okay, so if we go back to our example of Massmart, the holding company will have what we call separate financial statements, its own financial statements, and then Game will have its own financial statements, Macro its own financial statements. A quick example is, let's say you are employed by Massmart Holdings as a group accountant, and then your friends are employed by, there's one at Macro and another one at Game. So come end of the year, you will prepare annual financial statements for Massmart at a holding level, that's separate. And your friends at Game will also prepare financial statements for Game. Another friend at Macro prepare financial statements for Macro, another one at Builders Warehouse. Once those financial statements have been prepared, then they will send it to you. As a group accountant, you will then do what is called group financial statements, meaning now you consolidate all these financial statements from Game, from Macro, from Builders Warehouse, and then you have, together with your separate financial statements, and then you'll present what is known as group financial statement for the entire group. So that is what basically that means. In terms of the Companies Act, You need to prepare the financial statements for each entity, and then those will then be consolidated on top by Smart Holdings. The main focus of this of IFRS 3 business combination, it's basically the control. Okay, an investor considers all the relevant facts and circumstances when it assesses whether it controls an investee, and that is done on an ongoing basis. What does that mean? An investor will control an investee if all of the following, which is the power over the investee, its exposure or rights to or variable returns from its involvement with the investee, and the ability to use that power that it has over the investee to affect the amount of the investor's returns. So that is what basically, if you determine control, you'll have to look at the power, what is power, what are rights, what are variable returns, and then assess whether does that investor have the ability to affect does it have the power over the investor to affect the amount of the returns. Now, if you are given a discussion type question, you know where I'll start exactly where we are in this slide. I'll start by saying an investor controls an investee if and only you mention those three items. It's the power over the investee, the exposure or rights to variable returns from its involvement, and is the ability to use the power over the investee to affect the amount of investors' returns. And from there, you then need to go and look at what do you mean by power? What do you mean by rights? What do you mean by returns? And then you assess, as I said, the ability of the investor to affect the amount of investors' returns. That way, mainly if the question comes and you are required to discuss the discussion type question, that is where you need to look at. If it's not a discussion type question, there is a scenario that's given. Those are the things that you need to look at to determine whether the investee needs to be consolidated to the investor or to the holding company. Whether the holding company, because in most cases, I know it's the voting rights. We'll look at it just now, but it's not only the voting rights. That's a simplistic approach. If you have 50 plus 1, then you know that you have the power. It's not always like that. There are other factors that come into play that you need to be aware that we'll just look at now, especially when it comes to rights, and it comes to the definition of power, etc. So those are other things that you need to look at, even if you are given in a scenario, to determine whether are you supposed to consolidate or not. Let's quickly look at the power as the first item there, a power over the investee. This is when an investor has existing rights that give it the current ability to direct the relevant activities. That activities must significantly affect the investor's returns. As I said, the second bullet point, power arises from rights, which would normally be voting rights, but it's not always. It's more complicated, can be more complicated than that, but we will look at that. And then the other thing, two concepts that I believe we have come across when we're doing leases. It's the substantive rights and protective rights. When assessing whether an entity has power over an investee, you must look at the substantive rights. Protective rights are not taken into account. So, so that is what basically power relates to. If, for instance, let's quickly look at the substantive rights. I will quickly make an example. Let's take a scenario where company A has preference shares from company B. And those preference shares are convertible into ordinary shares. The rights or the the right to convert rests with the company A. Company B issued prefs, and company A bought those preference shares. So if that right is exercisable, it's at the option of the holder, not the issuer. In that instance, even if company A, let's say for instance, company A owns 30% of company B, but if those rights are convertible, we will likely give company A maybe 70% shareholding. There's a decision that needs to be. Let's take an example where it's not clear who owns company B. Company A has got 30%. We have got others owning 5, 10, 30, or whatever. But there is an important meeting that's going to sit in the next 30 days. Company B has got the right to convert, let's say within 15 days. As of today, when you assess who has got power, company B will have control because it has got a right to convert the preference shares into ordinary shares, and it's within 15 days before the crucial meeting sits in the next 30 days. So that is what substantive rights basically mean. They are exercisable when decision about the direction of the relevant activities need to be made. And then the most important thing is that the holder must have the practical ability to exercise those rights. So it cannot be that company A is waiting for certain events, which is it's not within its control for it to exercise those rights. If it's like that, then that's not substantive. But if straight it can exercise those rights, then those rights are substantive, and then they can be taken into account when assessing whether company A has got control over company B. Okay. And the other concept that we'll quickly look at is the protective rights. Okay. Protective rights are rights designed to protect the interests of the party holding those rights without giving the party power over another entity to which those rights relate. Maybe the same example. Let's look at, we have got company A, which has got rights to restrict company B from taking additional loans or entering into any transaction that will affect the credit profile of that company, of company B, because that will be to the detriment of company A, as an example. So in that instance, those are just protective rights. When assessing whether company A owns company B, you cannot take them into account. It's just the right that company A has, saying company B, you can't take additional loans, you can't do anything without my approval. So in that instance, those are just protective rights. They cannot be taken into account or when assessing whether company A has control over company B. Okay, let's quickly look at the next one. Rights that give an investor power over an investee. Examples of rights individually or in combination are voting rights. As I said, that in a perfect world, if there was any, we'll look at the voting rights. Anyone with 50 plus 1 easily said, no, this one has got control. But in practice, it's not always like that. There is a number of other factors. For instance, it's right to appoint or remove key personnel. It's the right to appoint or remove another entity that directs relevant activities, right to direct the investee to enter into transactions for the benefit of the investor, other rights that give the holder the ability to direct the relevant activities. It's a combination of those. It's not only that. For instance, if we can go to the example that we used of MassMart, let's say I'm thinking of bullet point 3 for the fourth one. Let's say MassMart owns a distribution center and then it directs game, other macro to use that distribution center. That's the right to direct the investment into transaction for the benefit of itself, of MassMart. So it's the combination of all of these. So in any given scenario, you must look at what else. You may be given, let's say there is a scenario where the company owns 55% of another company. But when you read the scenario, there is more information that basically indicates that we cannot rely on the voting rights of 50+1, but there are other issues at play. So you must also look at all of those to determine whether the company has control over the other. Okay. On top of that, we've got what is known as potential voting rights, PVRs. When assessing control, an investor considers its potential voting rights as well as potential voting rights of others to determine whether it has power. Examples of potential voting rights are convertible instruments and options. Most importantly is that those rights must be substantive. Exactly the same example that we use of convertible preference shares. If the investor, I'm an investor, I hold convertible preference shares from a certain company. Those are potential voting rights. If those potential voting rights, if those convertible preference shares will give me the ability to easily cross the 50, even if I own less than 50%, when assessing whether I control the company, let's say this is company B, that will be taken into account. Same if there are others. Let's say there are a number of shareholders. I do not have those convertible preference shares, but there's someone else, there's another shareholder who has the convertible preference shares. The same story applies. We'll have to consider those when we determine whether I have control or someone else has control over the company, which is company B in this instance, and then assess whether are those substantive, meaning there's nothing else, there are no conditions, it's something that I can use, they are not protective as we saw in the other slide. Then we can call them potential voting rights, and we can determine that I do control the company or not, someone else controls that particular company. Okay, we continue with potential voting rights. When considering potential voting rights as well as the purpose and design of any other involvement the investor has with the investee, if the investor also has voting or other decision-making rights related to the investee's activities, the investor assesses whether those rights, in combination with PVRs, potential voting rights, give the investor power. As we said, it's not always straightforward. In practice, there are so many other things that come into play. You can have potential voting rights, but if there are other issues at play, only to find that when you make the analysis and determining who has got control, only to find that it's someone else. So there's a lot of analysis, there's a lot of determination, there's a lot of judgment. Even when you prepare, as the preparer of financial statements, like in this instance, if you are at a group accountant for MassMart, you will have to explain by way of a note all assumptions and all the analyses that you used to determine why you believe that company A is a subsidiary, company B is not a subsidiary, especially in the case where you have more than 50%, but it's not consolidated, so those are some of the things, that you need to indicate when you prepare a set of financial statements. Okay, and then we come to what we call effective interest. Effective interest of the parent in the investee will reflect the parent's actual share in the equity, whether we've got 40% or we've got 50%, or we've got 60%. The percentage of effective interest in an investee does not always equal to the percentage of control, meaning the voting rights. I think we've spoken about this one. This can be due to potential voting rights and contractually ceded voting rights, So it's important, as I said, you determine, yes, the effective interest, but then look at other issues at play that might indicate that, no, it's not, this company shouldn't be consolidated, or it should be consolidated. Okay, let's look at two practical scenarios. The first one is, let's take company A. Company A owns 60% of company B. So straight away in this instance, we can see if in the absence of any other information, we can say A controls B because it's 50 plus 1. It's more than 50%. Okay, and then company B owns 30% of company C. It's less than 50%. So the absence of any information, we can say company B does not control C. Okay, and then company A as well owns 25% of company C. Okay, now what is the effective interest of company A in C? Okay, we will say it's the 60%, 30% plus our 25%, the 25% that is owned by company A, giving us an effective interest rate in C of 43%. But we need to consolidate here. Why do we need to consolidate? C is a subsidiary of A because A controls B, the 60%. A controls B, which then gives A full control of the 30%, so to say. So B, the full 30% of B is holding in C. So it's 30% here and plus the 25%, which basically means 55%. So in this instance, by the mere fact that A controls B, and then the 25% that it also holds in C, in this instance, there will be consolidation. Okay. Look at another scenario. In this instance, company A has 40% shareholding in company B. So A does not control B, it's less than 50%. Same as the previous slide. B has 30% of company C. So same story, B does not control C. A has 25% in C, giving it an effective interest rate of 37%. Okay, here we are not going to consolidate. Why? If you look here, we still have the 25%, we still have the 30%, as the previous slide that we consolidated, giving us the 55%. But company C is not a subsidiary of A because A does not control B, because we've got less than 50% of company B. So in that instance, we cannot, so company B, in other words, A does not control B, and it cannot control B's holding in company C. In that instance, there is no consolidation. I hope this one makes it a little bit clearer, ladies and gentlemen. This is in the absence of any other information that we've talked about, just trying to look at or rather determine the effective interest. Okay, now let's quickly look at how do you treat a certain degree of influence in group at group level. For instance, if you've got control is 50 plus 1, you will consolidate, again in the absence of any other information pointing otherwise. Then you've got what is known as joint control. The term that was used before was like your JVs, joint ventures. Here it depends on the joint arrangement, depending on what's spelled out in the agreement or in the contract. Then that will give the direction in terms of how it's accounted for at group level. Then when the company has what we know as significant influence, that is normally significant influence, anything between 25% and less than 50%, that's significant influence, then we use the equity method. Okay, it's also called an associate. So if you've got an associate, then it will be an equity method that will be used. If you have got a degree of influence which is less than significant influence, meaning it's less than 25%, in that instance, at group level, you treat it as an asset or a financial asset following the principles of EFFSC 9. Dealt with EFFSC 9, there were those three broad categories. It's up to you. It's up to the to the company holding level to determine how it treats it, whether it's going to be at amortized cost, fair value through OCI, or fair value through P&L. But it's just treated as a financial asset at group level, following the directives of EFFSC 9. So that's how most it will be treated. If it's controlled, then it will be consolidated. If it's a joint control, it will depend on the joint arrangement. There you will be given more information in terms of how it's dealt with, or rather, how is the joint arrangement set, and then that will determine how it's accounted for at group level. If it's significant influence or associate, anything between above 25%, less than 50%, then it will be equity method. So if it's less than significant, meaning it's less than 25%, then it will be treated as per EFFSC 9. That will just be a financial asset, following those categories that are spelled out there. Okay. Now let's look at another. We've looked at power, we've looked at rights, and then we're now looking at returns. Remember, we said, what is control? Control is power over investee. It's exposure or rights to variable returns from the involvement, rather from the parent involvement with the investee or the investor's involvement with the investee. Then it's the ability for the investor to use its power over the investee to affect the amount of the investor's returns. Okay, now returns here, we are talking about a scenario where an investor is exposed or has right to variable returns from its involvement with the investee. When the investor's returns from its involvement have the potential to vary as a result of the investor's performance. For instance, we've looked at some of these. You have got things like preference shares. They give you 10% fixed interest on annual basis. That does not vary with the performance of the investee. So in that instance, that's different. But in another one where you earn dividends based on what the investee, or rather based on the performance of the investee, when come end of the year, the investee decides to declare dividends to investors. Come next year, that investee did not perform well. It decides not to declare dividends. So those ones vary in with the performance of the investee. So only one investor can control an investee, but more than one party can share in the returns of an investee. We can have 10 investors, but out of all those 10, there must be one that controls the investee, depending on all other issues at play when we determine whether, rather, as to who owns or who controls that particular company. Okay, and then the link, looking at, that's also very important, even in the scenario, when you're given the scenario, you should be able to determine the link between the power and the returns. What does that mean? In addition to having power within the investee and exposure or rights to variable return, an investor must have the ability to use its power to affect its returns from its involvement with the investee. So, in other words, that power, if the investor, for instance, has the right to appoint the executive team, it has got the right to determine the strategy of the investee as to where should the investee go, all those things, then that's the link between the power and the returns, meaning if the executive team performs well, if the investee follows the strategies determined by the investor. So in that instance, there is a link between the power that the investor has and the returns. Okay. When assessing control, you need to look, as we said, there are so many things. You look at the relevant activities, how decisions about the relevant activities are made, who has the ability to direct those activities, meaning who says what, this is what must be done, who receives returns from those activities. In most cases, it will probably be clear in that the holder of the majority of the voting rights controls the investee. If we were to use the voting rights, as I said, 50+1 as an example, then we know, but it's not as clear cut as that. There are so many other things that come into play. Relevant activities and direction of relevant activities. A range of operating and financing activities may significantly affect the returns of an investment. When two or more investors have the current ability to direct relevant activities and those activities occur at different times, the investors shall determine which investor is able to direct the activities that most significantly affect those returns, consistently with the treatment of concurrent decision-making rights. Okay. The second bullet point, it's a bit of mouthful, but let me make a quick example. Let's take another company. Let's take Imperial, the logistic company. We've got Imperial Holdings at group level. Then we've got Imperial Logistics as a subsidiary. Now, let's say at a subsidiary level, Imperial Logistics, Imperial, I'll make it equal. Let's say Imperial Holdings holds 40% of the subsidiary, which is the logistic company. And then let's bring another investor. Coronation Fund Managers, they also own 40%. So the two own equally 40%, 40%. The other 20% is held by other investors. Now, Imperial Holdings determine the routes that the logistics company can use. It negotiates things like clients, the rates, etc. That is what basically, that's what directing relevant activities mean. Okay, that's now Coronation Fund on the other side. Let me use the example that I used before. It holds the right that prevents Imperial Logistics from entering into loan agreements, etc., etc. So if Imperial Logistics needs to enter into some loan agreements, it must consult Imperial Logistics. So in this instance, you've got two investors Imperial Holdings and Coronation Fund managers. They direct relevant activities of this company. But when it comes to what we determine which investor is able to direct the activity that most significantly affected the returns. So in this instance, we look as to which investor between the two, Imperial Holdings and Coronation Fund, direct the activities of this company that are likely to affect, or more likely, significantly likely to affect the returns of the logistics company. In this instance, it's clear that it's Imperial Holdings because that's how it makes money from the routes, from clients, etc., etc. The other investor holds the right just to determine the credit profile of the company. So in this instance, that's what we call about relevant activities and direction of those relevant activities. Assessing, taking from that, the conclusion will be the company that directs the relevant activities which have a clear connection with returns, it will be the Imperial Holdings as opposed to the other one, Coronation Fund managers. I hope that example makes it a little bit clearer. Okay, now exposure or rights to variable returns from an investee. An investor assesses whether returns from an investee are variable and how variable those returns are on the basis of the substance of the arrangement, regardless of the legal form. Example here is dividends, changes in the value of the investor's investment. I think we've looked at that as well, that if we have got an investor who's exposed to fixed returns as opposed to an investor who's exposed to variable returns. In this instance, in the form of dividends, we all know that declaring dividends is not a right per se. It's at the discretion of the company, depending on how it has performed, as opposed to things like cut 10% return on preference shares or debentures, whatever the case may be. So that is what, in this instance, the exposure or rights to variable returns from an investee. Okay, what are some of the accounting requirements? Okay, the first one is that when we do the consolidated financial statements, the uniform accounting policies should apply. What basically does that mean is that if, let's take another practical example. Let's say GAME depreciates its vehicles over 5 years. You then cannot have Massmart depreciating its vehicles over 10 years or 8 years, because when it comes to consolidations, it's going to become a bit messy, So have some uniform accounting policies that will make, the consolidation process, run smoothly without any glitches. Otherwise, auditors will have field day, will have a lot of explanation to sort of calculate and to explain. It becomes a bit messy. Consolidation of subsidiary begins on date the parent gains control and ceases on the date the parent loses control. Again, practically, when given some information in the scenario, it might happen that beginning of the year, here is company A holding some investment in company B. It's not consolidated because it does not have control, but somewhere during the year, there is some information that is given which gives company A control over company B. So if you are given that information in the scenario, you should be able to pick up that, okay, from this date, even though it was not consolidated in prior years, but from this date, company A has control over company B, so I need to control at the end of the financial year. And the opposite of that, it can happen that company B was consolidated in the prior years, but on a certain date during the financial year, company A loses control over company B. At the end of the year, then I am not going to consolidate because company A does not have control over company B. So that information if you're given in the scenario, you should be able to spot it, able to see when does the company, at other times it can be clear, at other times it cannot. You just need to look at the information that is given. The non-controlling interest NCI shall be presented in the statement of financial position within equity, but separately from the equity of the parent. That's also important, that in the consolidation, I think in the example that we will look at, the share capital amount of the NCI, it's not consolidated to their to that of the parent, but it's shown separately in the statement of financial position. We'll look at that just now. And then changes in a parent's ownership that does not result in loss of control are considered equity transactions. So it might happen that during the year there are certain changes, there are certain transactions that take place, but they do not necessarily result in a loss of control, you know, in the subsidiary. So those are just equity transactions, are not necessarily, they're not going to be treated as a loss of control where you need not consolidate, as it were. Okay. Then IS 27 says an entity may choose to account for subsidiaries, jointly controlled entities, and associates either at cost in accordance with EFFSC 9 or in their separate financial statements. The same method shall be used for each category of investment. Okay. As an accountant, group accountant for Massmart Holdings, you need to determine, I've got subsidiaries, I've got jointly controlled entities, I've got associates. How do I account for them? You have got an option, you can account for them at cost or using EFFSC 9. Now, in the separate financial statements, here we're talking about separate financial statements of Massmart Holdings, not the consolidated financial statements. That's also very, very important. Even in the question, it's very important to determine, you may be asked to process journal entries, but be careful as to at what level, is it separate financial statement or consolidated financial statement, you know, because those are two different animals, so to say. So here you determine as to which one you treat at cost, or rather you account at cost, and which one you're going to use EFFSC 9 in your own holding separate financial statements. Now, the last bullet point, it's important that the same method is used for each category. For instance, if I've got 5 subsidiaries, I've got 3 associates, I've got 2 jointly controlled entities. If I decide to treat my subsidiaries, if it's at cost, all of them, the 5 must be at cost. If I decide to use EFFSC 9 for associates, all of them must, you cannot have 3 at cost subsidiaries and then others at somewhere else. So you must put all of them in one category. I mean, all the category must use the same method. That's how, in terms of how you account for them, you know, that's just what this one basically means. So you cannot put others here in the same category. They are all associates, others are treated somewhere else. And it's important, I think it's the next slide that indicates as to what do you need to disclose, because here we've got some judgments, we've got assumptions, as we said, you know, that you may have a scenario where you have got 55%, but you do not have control. So whatever judgment, whatever assumption, whatever information that is there, you know, when you disclose in your note as a group accountant, you need to indicate that as such in your notes to annual financial statements. You know, you need to also disclose the interest in subsidiaries. You need to disclose interest in joint arrangements and associates, also interest in unconsolidated structured entities if the entity does have what we call structured entities. There's some guidance in IFRS 12 in terms of the disclosure of those, and whether there was any aggregation. So those are some of the things that you need to disclose, in your notes. Ladies and gentlemen, I'm not sure if there's any question before we move into the question that we will quickly look at today in our, let me quickly. Someone asked whether does, I'm assuming, she said control equal to 50 plus 1. I'm assuming that she wants to know whether do we have control once we have got 50 plus 1. It's in a perfect world, it's supposed to be like that, but it's not always like that. You know, in the absence, I'll say in the absence of any information, we can say it is like that once we have got more than 50%, you know. But if there's some information like the one that we were looking at, who controls what, who appoints the directors, who determines the strategy and all those things, that might change, you know, everything. But in simplistic form, as things stand, we can say yes. If it's more than 70% and there's no information, what is the rule in economics? In economics, ceteris paribus rule. In the absence of any other information, looking at what you've been given, it's a yes. Okay. Let's move through the question for the day, which is 5.2, notes on group annual financial statements. Okay. Set. This is the information. This is, I mean, it's a new book for consoles. Right. We've got H, who acquired 70% of the shares in S on 1 Jan 06 for 412,500. At this date, the retained earnings of the subsidiary was 100,000. Okay. We paid 412.5. But the retained earnings was 100,000. We acquired 70%. At the date of acquisition, H Limited considered the net assets of S Limited to be fairly valued in its statement of financial position, with the exception of land, which was considered to be worth 125,000 more than its carrying amount. S Limited did not adjust the value of the land in its books. Okay, just a principle. If you are acquiring a company, you're basically acquiring the assets of those company. That's it's in a simplistic form. That's what basically it's supposed to be. The net assets, the X amount, they are fairly valued. That is what you're acquiring. They can be a bargain purchase. They can be a goodwill, depending on what you have paid. Okay, we'll look at that. But in this instance, this company H looked at the net assets of S and it paid 412.5, but there was land which was 125,000 more than what it was when H acquired the investment in S. Okay. The NCI, the non-controlling interest at the date of acquisition of the subsidiary, were initially measured at their fair value of 170,000. Okay, happy? The following are the summarized statements of financial position of H and S at 31 December 09. We've got land 3.5 and 350 for H and S. Remember, we've got investment in S comes from H, 412,500. So it's at cost. As you can see, this is as 31 December 09. This is what was paid on the 1st of Jan 06. Current assets 1087.5 and 150. We've got share capital of the two entities. we've got retained earnings 2250175, non-current liabilities 1375 and 50,000. Okay. Now, assume that an increase in retained earnings has been the only movement in the equity of the subsidiary since the acquisition. So there's nothing else that has moved except for retained earnings. We are required to calculate, very important, the consolidated retained earnings figure at 31 December 09. You know, it's not separate, it's consolidated retained earnings for at 31 December 09. And then the second one is we'll have to prepare the consolidated statement of financial position also at 31 December 09. Okay, we need to ignore any form of taxation. So we need to ignore tax. Now, the first one, take 31 December 09. Let's take a minute. If you guys can calculate the consolidated retained earnings at 31 December, what will be the consolidated retained earnings for this group at 31 December 09? If we can take just a minute, 60 seconds. We'll look at it now. Thank you. Okay, ladies and gentlemen, let's go. I have 2250. That's 2,250,000. Okay, I think Sponello, you just took. Sorry. Where am I? The retained earnings, you just took H's retained earnings, 2250. Should be more than that. Any other takers? Okay, I don't see any. Okay, we were given this little bit of information here that we're assuming that the increase in retained earnings is the only movement in the equity. So what we need to also take into account, yes, I agree, that is, if that was half a mark, you'll get 2250 as H's retained earnings, but we also need, remember, we've got 70% interest in S. So we need to also take S's interest or S retained earnings in determining the consolidated retained earnings. And how do we do that? Remember, when we acquired this interest, we had, the retained earnings of S was 100,000, and currently 31 December 09 is sitting at 175,000. So it means it has increased. When you acquired, it was 100,000. It's now sitting at 175,000. So what basically means is that 175,000 31 December 09, less 100,000, what it was when we acquired. We take our 70%, and then we've got 52.5. That is, as retained earnings at the 2, then we've got 2302,500. Okay, right. Then the second part is that prepare H Limited consolidated statement of financial position. Okay, we are given this H and S. As I said, we've got Massmart, we've got Game, we've got Macro, we've got Builders Warehouse, etc. Now we need to consolidate those into H's statement of financial position. Okay, there are broadly two methods of doing that, and as far as I know, they are equally acceptable. The first one that you can use the journal entry method, meaning you just, that becomes your workings. Basically, you do you prepare journal entries and then you consolidate. The other one, you do an analysis of equity. It's a table that where you calculate the interest right from in this instance, the 1st of January 06 up until 31 December 09. You track that, you put it in a table, and then as part of your calculation, and then you go and consolidate. Okay. A word from me is that please be comfortable with the journal entry method, because there can be questions where you are asked to prepare journal entries just for consolidation purposes. Okay, so it's the two different methods, but my recommendation is that you also become comfortable with journal entries, because they may, at one stage, I'm pretty sure there will be a question that requires you to prepare pro forma journal entries to consolidate. All right, now let's start with the journal entry method. We'll quickly look at that one and then consolidate, and then we'll look at the other method, which is more of a worksheet. All right. Okay, we've got that one. Maybe let me say, calculate for me the goodwill in this question. We'll pass the journal entry, but I want you to calculate the goodwill for me. Given this information, okay, what information do we have? We paid 412,500. The retained earnings of S were 100,000, and then we're given some information that there was piece of land which was 125,000 more than its carrying amount. And then we're also given that the NCI, the non-controlling interest, at the date of acquisition was 170,000. What will be our goodwill? Did I give you all the information? I think yes. Maybe the share capital of S is 275,000. Assume it hasn't moved from 06 is still 275,000, no additional shares issued. So 275,000 share capital, 100,000 retained earnings, 125,000 land, which was more than fair value. We've got NCI. The amount that we paid was 412,500. What will be our goodwill? Okay, I've got commissioning saying 82,500. Yes, commissioning, you are right. You're spot on. It's 82,500. I'm not going to ask you how you calculated it. Because the time is not on our side. Let's quickly look at the journal entry. Okay. The share capital, as I said, the share capital has not moved. It's 275,000. So the pro forma journal entry, you'll debit share capital, you'll debit the retained earnings at acquisition, 100,000. That's what it was. And then the land was 125,000 more than its carrying amount. So it must be a debit, the increase in the value of the land. And then NCI, non-controlling interest, at acquisition, we were given it was 170,000. We paid 412,500, giving us a balancing figure on the debit of 82,500. Okay, so that's our goodwill. In an instance where the balancing figure is on the credit side, that becomes a bargain purchase. So on the debit side, it's a goodwill. On the other side, it's a bargain purchase. It means we got it a little bit cheaper. This instance, we had to pay more because of whatever. That's why we have got a goodwill amount. So that is the first journal entry. And then the second journal entry for checking now the increase in retained earnings, because that first journal entry, we had to put the retained earnings as at acquisition, 170,000. Now, the interest, the share of NCI on retained earnings will be the 30% of 75,000. 75,000 being 175,000 minus 100,000. Okay, where am I getting that figure? 175,000 as retained earnings minus at acquisition, 100,000 we're given somewhere here on top, 100,000. You take the 30%, so we've got the 22.5. Okay, let's now, based on these, let's now look at our consolidated statement of financial position. We've got NC, non-current assets, inclusive of goodwill, which is 3.5, that's land, plus 350, which is land of S, 125,000. 125,000 is that additional value of the land that we were told that initially it was 125,000 more than it was. Then it's the goodwill, 82,500, giving us 4,057,500. That is what we'll have at consolidated level, 4,057,500 non-current assets. Our current assets, 1,237,500, which is nothing but you add these two, 1087.5 plus 150,000. That will give you the 1,237 that is sitting here. Okay, and then we have the share capital, 1,375. The share capital, this one is for H only. 1,375. Remember, we said in one of the slides, we will only take the share capital of the holding company. We will then show the other one as a one-line item in our statement of financial position, which is what is sitting here. We'll come to it just now. And then retained earnings, 2,302, the one that we calculated above, the one that we calculated, where is it? 2,302,500. And then the NCI, 192,500. What is this? It's the 170,000 retained earnings plus 22,500, the last journal entry that we passed here, this 22.5, giving us 192,500. That is sitting in the consolidated statement of financial position as just one line item for NC, a non-controlling shareholders subsidiary. Then you add those equity, and then the non-current liabilities, it's nothing but 13750 plus sorry, 1375 plus 50,000 that's sitting here. So that will be sitting here, and then that's it. We have consolidated. Strictly nothing much, but having used the journal entries. Okay, now let's look at the other one. It's the other method, which is it's alternative 1, and then there's another one, it's alternative 2, but basically these ones are worksheets. Here you look at H, you have got S, and then debit and credit, and then you've got the consolidation. 3.5, that's the land of H, 350, that cost the land of S. Then we had to increase that the land of S by 125,000 because it was more than what it was initially. Then at consolidated level, giving us 3975. Investment in in S by H is 412.5. And then it's not consolidated, as you can see. Then we've got current assets as given 1087.5 and 150 as they are here, 1375 and 50, and then giving us 1237.5, and then as we've calculated the goodwill 82.5. Then we add those, we've got 5275 this side, 500 for S, and then we've got share capital for S. For H holding company is 135, for S it's 275, consolidate 1375, retained earnings 2250, sitting in the statement of financial position for H, and S 175,000 sitting there. Then we have had the 100,000 at acquisition, and then the 22.5, the NCI share of retained earnings. If you add those, will give us 192,500, as we have seen that. Then non-current liabilities, nothing, it's 1 plus 1. For H, it's for S, giving us 1425. You know, that's the worksheet method. Again, we can take this, go to our statement of financial position, and do the consolidation as we have done. But I hope you can see all the figures that to determine using the journal entries are here. Then quickly, as an alternative, which is alternative 2, again here you've got the equity of subsidiary, you've got the analysis of equity. Okay, you've got share capital, retained earnings, land, giving us the total. Then you've got NCI, the investment from H to S, then goodwill. Since retained, meaning since acquisition, retained earnings. We've got at acquisition, then you've got since acquisition. So we purchased 70% on the 1st of January 06. S was 275, retained earnings were 100. And remember, this side is for the subsidiary. Retained earnings were 100,000, an additional 125,000 for land. If you add those, they will give you 500,000. NCI, as it was determined, was 170,000. What we paid was 412,500, giving us a goodwill of that amount, which we take out. And then increase in retained earnings, as we said, that's the only movement that is there. It's the 75,000. Why 75,000? It's 175,000. 31 December 09, less 100,000 at acquisition, 175 minus 100, giving you 75,000. That's the total that we have. And then the share of the NCI, there it's 22 and a half, and then giving that. So that's a goodwill is there. So that is the worksheet. It's another alternative of the worksheet method. Whatever, you don't have to do both, as you can see, alternative 1 and alternative 2, but broadly, these are worksheets that you need, if you prefer using this method, that you can use. But it's either the worksheet or the journal entries that you can use, as we saw when we process those journal entries. So that's it, ladies and gentlemen. I'm not sure if there's any question, you can let me know, but It's a very simple example, but it touches on some of the most important aspects of consolidations, which are very important as you will be building on them going forward when you go through consolidations. Good news, I guess, is for your test next week, this part is not there, tutorial 6, but tutorial 1 to 5 that we've done in the past, the provisions, IS37, IS10, IS8, changes in estimate, correction of errors and accounting policies, same as IFRS 7, 9, and IS32, which is financial instruments, and also including Companies Act for the share capital portion. That's what your test will be covering next week, Monday, and which is a big end. Remember that also all your topics for accounts 2A, ACCT 211 are also examinable. So also remember that as well. So I think we've come to the end. If there's any question, you can unmute yourself or you can send it in the chat. But we've come to the end of our workshop. Next week, we'll still be doing consolidations as well. It will be the second part of consolidations before we move to other areas. Okay, I do not see any question. Ladies and gentlemen, we have come to the end of the workshop. All the best. And I know you're preparing for your test 1. A big good luck from us. The mock test is there, as Kerry said. You can practice, you know, it's gonna be exactly like as it is currently, so you don't have to sweat and do all funny things when you're supposed to write your test next week. So a big good luck from all of us for your test next week. Thank you very much.